So gold just had its biggest single day drop since 2013, right after hitting fresh all-time highs. We've seen silver and platinum both follow suit, following that same direction, sliding massively after those runs. And while that sounds shocking, it was due for some type of breather. Nothing just goes straight up in a straight line forever. So markets need moments like this reset just before deciding where that next move is going to be. So sometimes a breather is completely okay. Now, a lot of today's selling pressure we've seen came right after signs of the US and China trade tensions possibly continuing to cool off. Trump said he plans to meet with the Chinese leader Xi Jinping pretty soon and calling their relationship great. He's predicting this fantastic trade deal. That optimism paired with the US and Australia's signing of a rare earth trade agreement, it really gave investors this confidence that maybe the worst of the trade worries are behind us and everything's just up from now. So the risk on sentiment spilled over into the broader markets. We've seen the Dow climb today. That was one of the only major indices that actually climbed today. It climbed 0.47%. The S&P finished completely flat. That's a 0-0. The Nasdaq up 0.16%. We've seen gold, that one plunged. Gold plunged nearly 5.7%. And Bitcoin, which was up as high as right here, 5.5% earlier in the middle of the day. And then now it's just slightly positive near the end of the day, up about 0.28%. Now, that's really interesting where everything's really moving with just these numbers. It's the psychology behind all of these different trades because each one of these assets, the Dow, the S&P, the Nasdaq, the gold price, the price of Bitcoin, all of these represent different kinds of mindsets. And that's why they all move completely different than one another. So when it comes to how people view risk and view opportunity, all of these different charts, even TLT, all of these are in different groups of people's baskets. Now, let's start by talking about the Dow Jones Industrial Average. The Dow, which is heavy on value companies. Think of it as established names that pay consistent dividends and have long-term staying power. They've been here for quite a while. So when investors rotate into the Dow, it's often signals that they're looking for stability. They're looking for income or protection from volatility you'd see in some of these other major indexes. It's this sleep well at night section of the market. Not necessarily flashy, but it's pretty dependable when fear rises elsewhere. So that's the Dow, and some people they'll just have allocation to this, and this is just part of their portfolio. Like, you're rarely ever like 100% one of these charts. You usually have like this balanced mix. And then we lead into the S&P 500. On the S&P 500, it's seen as more of this blend. It's part growth and then part value. It's the middle ground that investors use when they want exposure to both stability and the innovation side of things, because it includes everything from tech giants to industrials to even healthcare. It's seen as the best single measure of the overall US economy, and that's why so many people watch these SPY so much. So when the S&P stalls like today, it can mean investors are still processing where to lean next, toward safety or toward risk. And it kind of seems like the Dow was the clear winner today. And then when we just continue down the track, we're going to continue talking about them. There's the Nasdaq. This is the home of the high growth, high risk sectors like technology, the AI narrative, biotech. I'm sure the Web3 companies are going to fall under this one. When the Nasdaq outperforms, it usually means that traders are confident. They're betting on the future, on innovation, on what's next, and that all of that's going to turn out really good. But when it lags, like today, falling negative, that's often a sign that investors are rotating out of risk into a more safer territory, maybe preparing for more uncertainty ahead, or um, it's just kind of ran for a while. Maybe like some of these other plays have been beaten up. So we'll get to that. Now, let's talk about gold. Because gold, this move was completely massive how it moved. So gold's appeal is really built on the idea of it being hard money, which is a store of value that can't be printed, it can't be inflated away like fiat currency, like the US dollar bill that we all transact in. So normally people buy gold when they want to protect their wealth. They want to hedge against uncertainty or really just escape the central bank driven markets, that US dollar that's just gone down and down and down in value. But here's the thing with gold. Gold has been on this historic tear, hitting records after records. And after such a run, even in the strongest uptrends, those charts that just go up and up and up and up and up, they can't go up forever. Sometimes they just need to cool off a little bit. So some investors likely took profits here while others really just rotated back into riskier assets now that the US China relations appear to be thawing out, and then it's back to boom time, back to party time. And that brings up one more that I wanted to talk about, one more asset, and that's Bitcoin. Many call it the digital gold. It's trying to be that same alternative store of value, but in a decentralized digital form. So Bitcoin gave up its all-time high just about 2 weeks ago, as high as what, like 124,000. And some analysts viewed that as this early warning, this omen, this bad omen for stocks, for the broader risk appetite, because they're like, man, these stocks have been going up, but at the same time, Bitcoin's just kind of like trending down, and it's not like this slow like sell off, like it was dumping when they were talking about this. So some just viewed that as some early sign, that kind of like canary in a coal mine for the stock market, that we could possibly start seeing a downswing. And with gold being at all-time highs, it's some people are probably just rotating out of their assets now, so to say, and buying Bitcoin, for example, that already possibly seen some of that downturn. And then we see treasury bonds, TLT 20-year plus US treasury bonds moving upwards lately. It's been moving up slow and steady, but that's another flight to safety kind of deal. Think of it as like the Dow of hedges. But I mean, what we're seeing now, it could be simply part of the same rebalancing process. Money just rotating between different assets as traders just recalibrate for what's next, because we got earnings, we got interest rate cuts coming, global trade developments, we got all these things that'll just keep on coming and changing and changing and changing and coming. And so what does all this tell us? Money never disappears, it just moves, and sometimes it flows into safety like gold, like bonds, and then other times it chases growth through like the NASDAQ, and every once in a while it hides out in cash waiting for clarity.